Friday's sell-off has all of the ingredients to start a larger market correction. The stronger than expected labor report in the pre-market sent interest rates substantially higher, pressuring equities lower. And there are three things, well, maybe four, that will help us navigate just how deep of a correction this ends up being. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we have a solid red-bodied bar with very minimal upper wick, not much to read into there, and virtually no lower wick. The sellers did a great job of closing price dead on the lows of the weekly range, which of course is a bearish data point. On the bar-to-bar count, when we're considering location, notice that we do have a higher high, but also a lower low. This is a classic outside bar. It's a bearish engulfer, which actually stacks up as a bearish data point. Think about it like this. On the gap up open, it should have been easier for buyers to produce on the bar-to-bar count a higher low, and that simply did not take place. Buyers are weak, sellers are building some strength here. More importantly, when we're considering the overall trend of the weekly time frame chart, we've really been talking about this key level for the past couple of weeks. Remember, previous resistance had the opportunity to act as support. That was a soft higher low, no daily downtrend. We finally had the beginning stages of a daily downtrend. We were trying to seek a firm higher low on the weekly. We held above again in the weekly bar from 2 weeks ago now, and last week we just closed firmly underneath that level. So is there a change in tone on the weekly time frame chart? I think the answer is absolutely. Now, I'm not going to sit here and say it's Armageddon. Oh my goodness, the market's going to crash and go to zero. In the introduction, I mentioned that there were 4 data points that could help us understand how deep the weekly correction could potentially be. And one of these things that I'm paying attention to, one of the 4 data points, is a possible retest of this breakout level from back here. Previous resistance, broke out, and then acted as support over here again. So if the market does continue its move in the downward direction, that's one potential target that helps us understand how deep the correction could potentially be. And that would bring price down closer to 565 roughly on the weekly time frame. Another measurement we could take here is just using our handy-dandy measuring stick from the top down to that pullback low. If I hover my cursor here, you can see it's roughly a 7% pullback from the all-time high. And if you count pullbacks in the S&P in particular, what you'll know is that roughly once a year, the market experiences something along the lines of a 10% correction. So does that start to get us close to that threshold? I think the answer is absolutely. Give a little bit of an extension through that, maybe a test of the weekly 50 SMA, we get our 10%, and that's a pullback that sets a potential monthly higher low, right? We know based on last weekend's update that there's plenty of room after the December close, right? There's plenty of room for a monthly higher low to form. So this is one potential location where we'll look for that. A quick comparison could be, if we just go back out here, remember the monthly higher low thesis from this area, right? We had this big weekly flat top, 1, 2, 3. Of course, it was the neckline of the inverted head and shoulders. We broke out, fell into a weekly downtrend, offered about a 10+% pullback, found a monthly higher low at the weekly 50 SMA, and then it was off to the races. Now, I'm not saying it has to be picture perfect. We need to see a nice gentle little weekly downtrend, then it's going to be off to the races again from here. But when we're thinking about where could this correction go, this is absolutely a top of mind target. A couple of other things that help us understand that the tone is changing on the weekly time frame. Let's come in from the August 5th low with the Fibonacci up to the high. We're still over that 38.2. So once again, I would not throw in the towel and say, oh my goodness, it's Armageddon. Markets are going to crash and just absolutely explode. But if we come in from this low, the last pivot low, up to the most recent all-time high, this should not really surprise anyone. We've just talked about 585 in the closure below. But remember, the Fibonacci 61.8 was confluence with that level, and we've closed underneath that. So what does that mean? The more time we spend underneath the 61.8, the more likely it is that you see a 100% retracement. That, of course, would continue the bearish pressure here. Another thing we can check in on, of course, is the anchored view apps on the weekly, and we're underneath a majority of the cluster now. Instead of, wicking off of this final point in the cluster and then closing in the mid, we're just completely closed underneath now. So again, is there a tone change on the weekly? Absolutely, and we're acknowledging that here in today's episode, right? Let's come in with the volume profile and check in from that perspective. We'll go auto zoom, and let's just drop this down to about a 9-month chart will be just fine. Let's take a closer look here and see that we have closed underneath the high volume node. So once again, where are some of the next high volume nodes that we should be aiming for? This strikes me as being reasonable, which is the equal lows we've been talking about. And then even beyond that, the next shelf is the retest of the weekly breakout level. So once again, this level in here, closer to 564, 565, really becomes attractive if there is going to be a larger drawdown in S&P markets. Let's take this down to a daily time frame chart. Let's start to evaluate this week's expected move. It's this gray box right over here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is forecast at 592.21, implying a lower high on the daily trend count. That, of course, is bearish. If we're contained by the lower bound, the number's at 568.70, implying a huge lower low. Once again, another bearish data point here. Now, if you tuned into the Wednesday update video, you know that we were talking about not wanting to be a hero inside of this box right here. And what you'll notice based on Friday's close is that we closed right at the bottom end of the box. The other thing to point out here is that technically speaking, that is a lower low on the daily time frame chart after lower highs. I think officially now that we have from here to here a lower low, I would be confident enough to start calling this a daily downtrend. I was a little bit more on the neutral fence in here, but now I would start to consider this a lower low daily downtrend has emerged. Of course, the big pattern in force is the head and shoulders, which everybody is still talking about, and rightfully so, it is in force, and we have started to break underneath the neckline. Of course, the election gap close is the target here at 576.75, and you'll notice that there is a lower wick on the Friday session. We didn't quite make it all the way there. That is noteworthy to me, and we'll talk about the opportunity for a potential counter trend. But what's the name of the game in a daily downtrend after setting a lower low? I mean, really, we just want to look for shortable outcomes on daily lower highs to continue the trend in the downward direction. And these are two major ideas here on the daily time frame. Any counter trends that reject the 584.75 level set a lower high, looking for continuation lower. Any lower highs that are set here at 590.75 on the back test, of course, set a lower high and we'll look for continuation to the downside. The next thing to talk about is the fact that Friday's session was technically a gap down, right? Or, well, we opened right inside, just a hair inside of the Wednesday range. Remember, Thursday the market was closed. But on the labor report information, we of course did see, just before the bell rang, a intended gap down. Generally, the weakness opening underneath the low of the hammer candle sort of played out exactly as we described in the Wednesday update video, where, hey, any buyers who started to step up here on the gap down will likely get taken out of that position, right? And that's certainly what we have with the weaker close back down towards that 580.75. So again, trying to acknowledge here some of the subtle changes in tone out of the daily time frame chart. I would still take an approach where we're respectful of the amount of volatility that has emerged in the market. Remember, we went through the exercise on Wednesday of saying, hey, this balance range and even this balance range up here are about a third of the size of the current balance range. So stops get wider, position sizes get smaller, right? We'll just give that reminder one more time. So with a daily downtrend emerging, let's start talking about some downside targets beyond 576.75. The cluster lows of this 4-day balance ahead of the election gap up is down at 569.75, and to me, that would be a reasonable target, noting that it is within the weekly expected move here. Anything beyond that, there's a pretty important shelf, which is that weekly breakout level, right? 1, 2, 3, broke through, retest higher low here, which is at 565. That's that weekly level that we were just describing. So if markets end up making it down towards that area, is this a place where I would start thinking about potential reversals back in the upward direction? Absolutely. Right? Absolutely. Especially over time, depending on how long it takes to potentially get there. The daily 200 SMA, which, air quotes, is a holy grail moving average. That's one of the more infamous moving averages. If you can catch support there, that would be the first interaction off of the daily 200 in a very, very long time. Let's take a look actually and see where the last one was. What you'll notice here is there's a little overshoot. This is after, right? This is that weekly pullback we just described. So, you can see the similarities in the market structure. There's a little bit of an overshoot here, but generally finding support near the weekly retest level, daily 200 SMA. Again, I'm not saying it has to be the exact same. History doesn't always repeat itself perfectly, but sometimes it rhymes, right? So if we see this 200 SMA meeting us for confluence around 565, that to me might start to be an indication where we say, okay, maybe the correction is air quotes over. Now, if the weekly trend and monthly trend both flip to down, then the daily 200 is not going to be a saving grace. And we'll take that in stride when and if it takes place. But let's not, let's not, what do they say? Let's not put the horse before the carriage, or let's not put the carriage before the horse. You guys correct me in the chat on what the proper analogy is there. So daily charts covered. Where do I change my tone and say like, wow, that was just a flash in the pan, it's instantly back to bullish? I would need to see price acceptance over 590.75, which as of right now seems to be lower odds after the failed gap up on Monday, the clean breakdown through the Tuesday session with no intraday buyers stepping up there, a rejection on Wednesday, and the gap down on Friday. So lower odds, but I will change my tone slightly if we're back over 590.75. Let's take it down to an hourly time frame chart. And let's see what we can learn from this perspective. So once again, here is your volatile range. We have started to break down underneath. You can even see intraday as we pushed into the election gap. The first response out of it actually sets an intraday lower high underneath 584.75. So as long as we're underneath that level, once again, it's quite clear that the bears are in control of this market. As we continue to look at the downside targets, I also want to take a look at the measured move from the head and shoulders. So if this, first of all, is just a bear flag, then of course we could easily find ourselves at that 569.75. So any lower highs that persist, Brigade bolts intraday, close the election gap. Anything underneath for a Brigade bolt lower high, 576.75, also plays in the downward direction. There's really not much structure until that 569.75, right? So that's your downside there. Even if the market opens in this range here, Brigade bolts above, I would seek a lower high on the daily time frame chart under 590.75 first. That's playing along with the trend that's clearly been established here with these lower highs. Another lower high under the daily 50 SMA, underneath our key line in the sand, which was really set from the Thursday session after the Powell plunge. That was the high, right? This is really where the market had the best opportunity for this to preserve the daily uptrend. Obviously, that has not taken place. Again, we're acknowledging these changes in tone from the market. So this lower high is certainly something that could be set underneath. You could look for an intraday double top. It could be a head and shoulders, and we'll start to navigate back in the downward direction, ultimately looking for that gap to close 576.75. A couple of Fibonacci retracements that will help us understand some of this. If we come in from the weekly high to the weekly low, the fibs are kind of in no man's land. One thing that I would just sort of read into slightly is that if we do get the rejection of the 590.75 level, it keeps us underneath the Fibonacci 61.8, which, as we all know, is a key line in the sand from a Fib analysis perspective. Okay, let's clear that up. Let's take a look at the first and foremost, the intraday anchored VWAPs. You can see here, notably on the Wednesday session, we've sort of found resistance underneath that daily line in the sand at the 590.75. You have the anchored VWAP from here. This is the all-time high anchored VWAP. You have a Powell plunge anchored VWAP, as well as the gap down open from the Friday that followed that anchored VWAP there. And the cluster was really sitting right at that area, offering the lower high. And once again, as long as we're underneath that, I think it makes sense that the bears absolutely have more of an edge. Or if you want to flip the script and think about it as more of a, okay, if anybody bought this move down here on the gap down open from that Friday session, are they above or underwater? They're certainly underwater as of right now. That's what the VWAP would suggest, right? The average buyer from this point going forward is underwater. So that is what the VWAPs are telling us. Once again, a little bit more of a bearish data point there. And I do just want to go one more time out to the daily time frame chart. We made a joke out of this in last weekend's update, but we'll take the measured move of the head and shoulders and just say it's getting pretty frothy down there at that 552 level. Remember, it was sort of a joke in the comment section last week. We could joke about it again if you'd like, but that is a potential target. I would, again, start to say, okay, 565 is the 61.8 extension. That makes a little bit more sense based on weekly structure. If that breaks, then over time, absolutely, 552 could be in the cards, but let's not get ahead of ourselves here. I think that one step at a time is still the correct approach, as we're just starting the breakdown of this balance range right here. We're just starting the breakdown of the head and shoulders, okay? So it doesn't need to find itself here in the blink of an eye. And as we'll see as we move through today's analysis, there's actually a couple of things that keep me a little bit reserved. And although I think the weight of the evidence has shifted to become slightly more bearish in the short term, there's a couple of things that are still bullish, undoubtedly. So here's the market internals. Let's take a look at this. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. A couple of big takeaways is that as the Friday session was selling off, of course, the volume reads on the session were substantial, underneath negative 300 million. On the week, net flows were not quite there. We're looking at negative 500 million if we want something substantial. So we didn't quite make it there, but nonetheless, still bearish. Another thing that we talked about on the Wednesday night video was that we had volume outflows as the market was consolidating, going sideways on the Wednesday session. So that was a bearish divergence, sort of prepping us just a bit. Of course, the news catalyst had a lot to do with this, but prepping us for this continuation to the downside. Advanced decline line spends all day on Friday in trend lower zone, and the cumulative build doesn't quite get to substantial. That would be negative 5,000, but it is, undoubtedly more bearish than bullish, of course, at negative 33.33. So internals do suggest that stronger sellers are starting to emerge from the woodwork. This is not as strong of a market as it once was. If we take a look over at the market profile for the ES, I think the biggest thing that we'll talk about here is just the fact that the value area, even though we gapped up on the Monday open, it never made an attempt all week to find overlapping value, right? And you can just see value here. It's slammed way towards the lows of the Friday session. It's completely underneath the low. The point of control is underneath the low of that prior session from back here. So generally speaking, do, once again, bears have more of an edge? The answer is absolutely. And if you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. There aren't very many poor highs or poor lows to talk about here. There's been a lot of repair at the highs and lows. This thin structure is still interesting, and we can carry that forward if there is going to be a larger reversal. But as we talked about on the SPY hourly and even daily, there's quite a lot of work before we're over that 6,000 mark, which is the equivalent of that 590.75 we were just talking about on the SPY. With that, let's jump back on over the platform here, and we will get into data point number 2 that starts to have me somewhat a little bit more on the bullish side. It's definitely keeping me cautious of the breakdown in the S&P 500, and that's none other than the QQQ on a weekly time frame chart. If you've been tuned into the pre-market preps, if you follow us on the Twitter feed, the X feed, then one of the things we've been talking about here, and we'll get to candle structure and location and all that good stuff, but this is point 2. In the intro, I said there were 4 things that are going to help us navigate how deep this correction possibly is. Well, point number 2 is the NASDAQ and whether or not it holds or breaks this previous all-time high. It's incredibly difficult for me to say anything bearish about the NASDAQ 100 as long as we're over this 503.25 mark. I mean, how could we say anything other than possible bull flag respecting the previous all-time high? So I'm of the mindset right now that, yes, the S&P is looking pretty weak, but we know that the S&P is tech-dominated, and if the NASDAQ does not break down underneath this level from a higher time frame perspective, I don't know that it really turns into this Armageddon crash that everybody feels that it's going to become. And, I'll change my tone as soon as this Brigade bolts or sets some movement underneath the 503.25. Please, don't misunderstand what I'm saying. If it breaks, I will change my tone, and it will be fuel to the fire for further downside in the S&P 500. But I would not want to be an aggressive short coming into the level from the top side down. I would want to see a retest lower high underneath. That's where the best short opportunity unfolds, in my opinion. So let's get back to our standard approach here, which of course is candled structure and location. What do we see in terms of structure? Very similar to the S&P 500, maybe a little bit more equal in terms of the length of the upper and lower wicks. Undoubtedly a solid red-bodied bar. It's a bearish engulfer with the higher high as well as the lower low. We did end up closing a little bit more, I shouldn't even use the word firmly, but we are undoubtedly inside of the previous week's range, whereas the S&P was right at the low, if not slightly below the previous week's low. You're kind of splitting hairs when it comes to analysis like that, but a small difference between the two. When we're counting the trend here, we absolutely still have the opportunity for, in my opinion, just a soft higher low. Soft higher low could have been set here. The fact that this is still possibly a firm higher low to me is still interesting from here to here, from here to here. And this really ties into that first analysis we conducted here on the QQQ, which was just that if we're over this level, I would still think of this as a firm higher low on the NASDAQ weekly, offering the opportunity for trend continuation in the upward direction. As a matter of fact, it's not even a crazy idea to say something along the lines of hey, I went out long on Friday looking for risk reward like this, generally speaking, trying to navigate that sort of range, seeking a weekly higher low specific to the NASDAQ. A little bit more difficult to do in the S&P, but in the NASDAQ, absolutely here. That sort of risk reward makes sense to me. As it comes to additional indications, let's check in on our Fibonacci's. From the bottom up to the top, that's the August 5th low. Still well above the Fibonacci 38.2 from here up to the high. We've closed above the 61.8. So once again, are you starting to see some of the divergences that I think are very important to the fate of the S&P 500? Ultimately, it's just that NASDAQ's not really as weak on a relative basis to the S&P 500 over the 61.8 with a weekly close. So looking pretty good there. Let's check in on our anchored VWAPs on the weekly. Above more of the cluster than the S&P. The S&P had closed here on a relative, actually here on a relative basis. It was only over one of the anchored VWAPs, whereas the NASDAQ is certainly over 3 of the anchored view apps at this point in time. So again, a little bit of relative strength from that perspective. Hopefully these illustrations help us sort of understand and come to grips with the reality of the situation, right? It's not just like, oh, I feel like the market's going to break down. It's no, what is actually happening with the data points? It's not suggesting in the NASDAQ yet that everything is, it's a lost cause. As we take a look at the high volume shelf, which exists down here, I think that's still within striking distance, and to me, basically aligns with the prior all-time high. If I just do something like this, instead of 6 months, let's try, 9 months, and you can see, there it is. That high volume shelf is perfect alignment. So as long as we're above that, I really don't feel as though the NASDAQ is going to help pressure, the S&P 500 lower to any major degree. So this is sort of balancing the analysis a little bit, right? As we take it down to the daily time frame chart out of the NASDAQ, though, I think we can all, come to agreement that the daily trend has flipped to down. I mean, here's the weekly expected move. If you're not familiar, again, that video tutorial already flashed up, but the upper bound is at 520.17. The lower bound is at 494.23, still offering a lower high and a lower low. So don't get me wrong, I'm not trying to sit here and say that because the QQQ weekly chart is still over that level, it's rainbows and butterflies. It's not. There's still some work that needs to be done on the daily time frame chart, but I think that the higher time frame is going to at least guide us in terms of how aggressive our sentiment should or should not be when it comes to this potential trade idea unfolding. So there you can see it's the holy grail level at 503.25. Notice that we have a little bit more of a lower wick on the daily bar than the S&P 500. We still did close underneath this shelf at 510, which is not a great indication. We did close underneath the daily 50 SMA. Remember that the NASDAQ had yet to do that substantially up until the Friday session. So a little bit of relative strength is gone from that perspective. We're undoubtedly underneath this box here with the close on Friday. So again, it's not rainbows and butterflies, but the trade ideas that I would start to envision for this upcoming week really rely on 510 and 503.25. If we're just in here, I would not be aggressive on the short side whatsoever. I would tend to think that this Brigade bolt back to the upside actually squeezes shorts who are short late to the party. Higher low here easily gets priced up to 517.75, the intra-range level from this area. And then beyond that, it's just sort of rainbows and butterflies looking for the equal high. And, just to continue to play this out in terms of what's happening with the trend, if you get a break of that resistance trend line, that certainly starts to stack up as much more of a bullish data point compared to a bearish one. So you could easily see the path, or at least I can easily see the path for a reversal more clearly in the QQQ versus the S&P 500. If we get this consolidation that ultimately Brigade bolts underneath 503.25, then again, I'll be the first one to raise my hand and say like, hey, I'll give you the classic turkey hand drawing. I'll be the first one to raise my hand and say, hey, we're changing tone to being a little bit more bearish. We're underneath the previous all-time high. 503.25 is not holding. We'll start actively seeking lower high ideas, short opportunity ideas. The election gap still has a little ways to close. That's 492.85. Beyond that, there's a pretty substantial area back here. You could remember this as the weekly double bottom neckline. Acted as loose support a couple of times through here at 484.50. So there's plenty of, there's downside targets to be had. I just don't think it's appropriate to jump the gun and start looking for shorts until we're firmly underneath that 503.25. So we've beat that one to a pulp on the daily chart. Let's drop it down to the hourly. What do we see over here? It's the same thing basically as the S&P 500. It's the same thing as the daily analysis, where consolidation here, yes, in theory, keeps bear flag in play. I would not take the breakdown of the bear flag unless there's a lower high underneath 503.25, as we've described in great detail. If we're going to squeeze out participants from the shorts late to the party down here, it's just all the same. I think the levels are very, very clean here on the QQQ. The hourly gives us a slightly different approach, but just reinforcing the same exact numbers. Let's come in with the intraday anchored view apps. You'll notice here that they are clustered around that 517.75. To me, I don't necessarily think I'd even wait for a recapture of that level to be much more aggressively bullish. I think that over 510, those theses can already start to emerge for longs back to the upside. So 510 really holds the key. Yes, we'll have to respect 517.75, and yes, ultimately it just is the midpoint of this balance range in here, but I do believe that look below and fail should ultimately bring us to the top end of the range. That's typically how the pattern plays out, right? You fail underneath the bottom, and the target should always be the opposing end of the balance, which is up here. So we'll take that one step at a time, and again, if it is going to be a bear flag, we have plenty of targets to aim for to the downside. Brigade bolts here. You can walk them down, same numbers as the daily time frame chart. Let's quickly check in from a Fibonacci perspective from the high to the low. There we go. 61.8, it's there with that 517.75 level. 38.2 is sort of in no man's land. Let's clear that up, and let's take it over to the internals for the NASDAQ side of things. And let's see what else we can learn from the NASDAQ internals. So stronger volume outflows on the Wednesday session, and we had the follow-up Friday session as well. So undoubtedly, at the exchange level, I'm not trying to say that like catching the falling knife dead on the lows is the best idea. There's some stronger selling here, so we'll respect that. There's a high degree of correlation, which always sort of indicates to me, at least, along with credit spreads, and you can look at the VIX outright, but high degrees of correlation always indicate high degrees of volatility, so be mindful of that underneath trend lower zone here at negative 2,000. And the cumulative build, absolutely bearish on Friday as well. So, I would wait, I guess the weight of the evidence, as we continue to use that term, would tell us that waiting patiently, not to use the word too much, but waiting for this higher low here over 510 is probably paramount, seeing what's going on with those market internals. Let's quickly check in on the market profile. At a loss for words there for a moment. Market profile, and see what else we can learn about the way value has developed. It's very similar to the ES, right, where you have value lower, lower here, and even still lower on that Friday session here. Where did value end up relative to this? I think that it's more so overlapping to up, and the point of control is also higher than that prior low. So as we're seeking the subtleties of technical analysis, again, I think that there's a little bit more relative strength over in the NASDAQ here. Let's go ahead and take a look at the IWM for our small caps, which of course happen to be the laggard of the bunch, much more sensitive to our economic data. Let's throw on the clean drawing set here. So on the weekly time frame chart, undoubtedly a nasty candle for the reason that we continue to reject in its upper wick this weekly breakout level. So we're a little ahead of ourselves. Let's stick with candle structure and location. Solid red body bar, sellers in control, closing weak on the lows. We opened over the previous candle's high, no higher low. We actually had a lower low as well, outside bar, very similar, right? And again, that structure here, 227, continues to offer or suggest that this entire move here was nothing more than a failed breakout. So as long as we're underneath this level, it's very difficult for me to be long-sided in the IWM or even think of this as a stronger tailwind, bullish pressure for the S&P 500. So, maybe this contrasted with the QQQ higher low sort of, evens out. I would sort of give the impression or impart that the S&P is definitely more so tech dominated than it is small cap or smaller company dominated, and you can just see this based on the fact that it's cap weighted in the S&P 500. So I would probably lean into the QQQ holding that higher low over 503 as being far more important of a data point relative to IWM being underneath this 227, right? So anyways, that's how I would reconcile those two data points. On the weekly chart, not looking good. If we take a look here through the lens of Fibonacci from the August 5th low to the most recent high at the 61.8, remember in both of the other indices, we were still over the 38.2. Obviously, if you come in from the election gap up candle low to the high, we're underneath the 100% retracement. So is it bearish? The answer is absolutely here on the IWM weekly. Let's take a look at the anchored VWAPs from the weekly perspective and see what else we can learn from that point of view. There we go. Underneath, majority of them, still underneath all the important ones, all-time high. This, of course, is the election gap up. This is the previous high and low of what I would consider a weekly range over here, and the lowest low from the October reversal. Back here is just hanging out down below. So is it possible that this catches support? Maybe, but of course that implies intra-week, intraday bearish pressure for the S&P 500 at a lesser degree, though, than what the QQQ is doing. If the QQQ is also down, obviously, if both of these things are moving in lockstep, NASDAQ down, small caps down, obviously S&P 500 probably down. So that's what we have here. We could take a look at the volume profile really quickly. Zooming out, we need actually more years to capture the previous balance range up here. The more time we spend breaking down, and it's great that we can still see this high volume node there, the more time we spend breaking down underneath 227, the more time we're actually rejecting this high volume node and all the overhead supply from here during this long-standing consolidation, which of course is a slightly more bearish data point. Let's go down to a daily time frame chart. Let's take a look at the weekly expected move. We can see that in gray right here. The upper bound is at 223.25. The bottom is at 210.40, implying a lower high as well as a lower low, not a shocker, just like the other indices as well. You'll notice that we're already at the daily 200 SMA. Is it possible that this offers a little bit of a support point here? It's possible. You'll notice just based on previous interactions, support at the 200, support at the 200, support at the 200, maybe a little bit of support here at the 200, but I think that the biggest deal for IWM is actually going to rely a little bit more so, and I'm not a big fan of this. I prefer putting the technicals first because price is what pays, but we do know that there's a big CPI inflation report coming out on the Wednesday session this week. So if CPI comes in hotter than the expectations, I don't think the 200 SMA is going to be any sort of saving grace. Ahead of Wednesday, yeah, there might be a little bit of a counter trend move, retest the bottom end of this balance range right here, but CPI comes in hot, it's game over. I think that this continues moving lower as the market basically comes to terms with, and we'll talk more about this in the fundamental section in a bit, higher for longer from the Fed. As we're getting back to the technicals though, zooming in over here, again, a little bit of a lower wick, so first thought might be an attempt to get over 218, but I would just seek a lower high. The trend here is clearly down on the weekly time frame chart. Massive lower high, possibility for a lower high here at the midpoint of this balance range, which really becomes more clear on the hourly time frame chart. So let's go there now. A couple of things to point out. Here's that balance range we were just describing. Let's zoom in a little bit better. There we go. There's the balance range. We had look above and fail number 1, look above and fail number 2, both of those rejecting the weekly lower high level we just described at 227, making sense. This is now breaking down as what you could just consider a bear flag on the daily time frame chart. So under 218, kiss it goodbye. I think we're lower. Brigade bolts over 218, again, seeking a lower high here at 221.65, the midpoint of this range. Flag highs, a little bit of support, a little bit of resistance, little support, kind of ground through it, chop through it here, but then cleaner resistance, support. You get the gist here at 221.65, thinking a daily lower high could be offered at the midpoint, that inflection point of the range here. So this is not a helping case for the S&P 500. Where do I change my tone? This would have to be, like buyers step up out of the woodwork and say, you know what, I don't care what the Fed does, which would be unlikely, right? This is just a Goldilocks situation. Where would I become more bullish? Up here, right? This is where I become more bullish on small caps. Prove it to me that you deserve my money over 227, right? Just not even a question as of right now. We could technically take a look at a couple of the additional indications just for the sake of being, thorough in the investigation. Obviously, underneath the Fibonacci from the top of the Powell plunge to the bottom. If you bring this to the bottom here, notice that the 38.2 is aligned directly with that 221 level, 221.865 level that we were just describing. If we throw on the intraday anchored VWAPs, you'll notice that they are clustered there as well, offering a great opportunity for that lower high. Let's take it on over to the small caps market internals, Russell internals, index specific. What do we see here? Decent volume outflows, but not as substantial as the other components of the broad market. Still in trend lower zone here, and a bearish cumulative build on the tick as well. Let's take it to the market profile, and we're going to be not surprised at all to see that this balance range, of course, resolved lower, and value undoubtedly is to the downside. Not much to really glean from the market profile in a situation like this. So with that, let's get back on over to the S&P 500 side of the market. Let's give this little reset here, and we'll start talking about our sectors, supporting evidence sectors, because this is going to segue into point number 3 about how deep this market correction could potentially get. First things first, weekly performance. What led the pack? Energy leads the pack. Healthcare leads the pack. Those are the only 2 green sectors on the week. You can see up 59 and 53 basis points respectively at the bottom end of the barrel. It's good old semiconductors, right, down 4.44%, followed by real estate getting hit based on rates moving higher, of course. Then we have the technology sector as well as discretionary. Now, what you'll notice about this is the distribution of sectors is clearly suggesting a risk-off rotation, right? And, well, that to me is important to call out. Obviously, your risk-off style sectors or inflation-specific, energy at least, sectors are outperforming here, but it's really about the lack of performance out of these guys over here. Now, the market, of course, is pulling back under those circumstances. So there's not a divergent short where the market's grinding in the upward direction, not being supported by the heavyweight components. This is just, no, the heavyweight components are causing the downside. So that is a subtle nod to risk off. The market does not seem to be as thrilled about taking risk as it once was. Let's check in on the structural charts and evaluate what's happening here. I think energy coming back into range is going to be a subtle pressure to the upside for the big bad I word, inflation with a capital I. And that, of course, helps us to understand what could happen on Wednesday. If inflation comes in hotter than the expectations, and the expectation is already an uptick from prior, just keep that in mind. So a hotter read is like, oh my goodness, a hotter read than prior and some, right? So inflation expectations with energy moving higher don't really look great here. Another thing that we don't oftentimes talk about, we go to crude sometimes. You can look at crude futures here, which have been moving in the upward direction. They're clearly over this big level that we've been talking about a lot in the past, right? So plenty of opportunity for inflation via, oil. But let's take a look at copper, HG. They call this Dr. Copper sometimes, but one of the things to just point out over here is copper's in everything, right? From batteries to plumbing. Well, these days plumbing is PVC anyways. a lot of things require copper just for production, industrial production. So what do we see here? A break of the resistance trend line. If copper starts to heat up, what is it going to do to prices? Probably put upward pressure, right? So is that inflationary here out of the HG? Slightly, right? Let's continue along, though, and take a look at the healthcare sector. Healthcare, although it's technically green on the week, is this looking like a constructive chart? No, absolutely not. It's got huge lower highs, right? So one of the things I want you to keep tally of in the back of your head as we're going through is how many of these sector charts are still in uptrends, how many of them are in downtrends, or how many of them are sort of neutral in between. As of right now, we've seen energy neutral. We have healthcare definitely in a downtrend, so a counter trend lower high can still be set. That's still bearish pressure for the S&P. As we look at semiconductors, huge failure into the end of the week. This, of course, being the major balance range. We gave it a little bit of the benefit of the doubt on the Wednesday session with the hammer right off the top end of the range. Clearly failed that on the Friday session. Now just firmly in the midpoint. Another example of a look above, and fail, which has to be undoubtedly more bearish pressure for the S&P 500 as well as the NASDAQ, right? So this one, neutral until proven otherwise, but with some bearish undertones. Real estate, new swing low. We always know in the small, lightweight sectors, the new swing lows, new swing highs are really what matter most. New swing low here is bearish, undoubtedly. Technology sector, what do we see over here? Still thinking about the poor high that has not gone anywhere. It's still up there at the all-time high, 242. But generally, balance range, trying to hold on to the absolute final line in the sand. There's no ifs, ands, or buts about it. It's 228, 227. We talked about that in the past. If we could hold up above it, then fine. Maybe we'll remain on that neutral front. If we start to crack it, it's game over, and this starts to fall into a daily downtrend. So we're seeing some risks start to emerge in the market, right? Let's continue along to the XLY. What do we see with this? Highs, lower highs, lows, lower lows, weekly higher low if it wants to double bottom out, but we're not even there yet. We're not even close to the neckline. The neckline is a higher high over 227.50. It's not in play. If it happens, great. It'll save the day. But until proven otherwise, this is also subtle bearish pressure for the S&P. So as we're thinking about these data points that support, continued pullback, the sectors don't look as good as they once did back over here, right? You'll notice in financials, the second heaviest weighted sector in the S&P 500, big time lower high, breaking from what could be considered a bear flag to close the remainder of the election gap over here. That's a possibility for bearish continuation. If it finds support in this zone, maybe we change our tone over time if it becomes constructive, but to get there, undoubtedly bearish. Let's take a look at consumer staples and see what's going on from this perspective. Bearish, right? We have a double top. We're underneath the neckline happening over here. You have this big area. You're underneath the daily 200 SMA. You're underneath the weekly range high. I've labeled this, very, very particularly for a reason, because if you zoom out to a multi-year chart here and have a look, that level, if I zoom in a little bit so we can at least see which label it is right here. It's the big range high at 77.50. So as long as price is underneath that, I am hard-pressed to say anything bullish about the XLP, which of course is D for defensive anyways, and it is lightweight, but it's just certainly not helping the case for a more bullish S&P. We talked about the S&P, here's the XLC. Let's drop this back down to an yearly chart, Communications, again, the list goes on and on. We're seeing these subtle shifts where instead of setting higher lows on the weekly chart, breaking out of double bottom necklines, we're actually breaking down. So the tone is undoubtedly changing. The more sectors we rip through, the more we start to see, yes, these things are deteriorating, right? Utilities in a downtrend, bear flag over here. It is more bond-like, it is D for defensive. It wouldn't shock me if it started to see a little bit of an uptick here, but it's not going to save the S&P. Speaking of bonds, here is the TLT, and it came very close to closing that gap. I still have my short puts just for the sake of transparency. I am still short puts at the 85 strike expiring about mid-February. I'll either get assigned, which is great, give me the TLT, or they will expire worthless if there is a counter trend move. As of right now, I'm thinking that the assignment is slightly more likely with the breakout in rates. All it's going to take is a hot CPI print on Wednesday. These puts will likely get assigned. So that is A-okay with me though. Here's the XLI. What do we see over here? In a downtrend, yes. In a bear flag, absolutely. Did it attempt to break out over this 134 for a reversal? Absolutely not. So again, thinking about the S&P 500, you can see the theme here. It's really not looking pretty. We'll put it that way. It's not looking pretty. We have inflationary pressures out of energy and copper. We don't really have strong uptrends anymore across a majority of the sectors here that matter. Materials, the lightest weight sector, sitting down here on the lows. I think the best thing that we've done over the last couple of sessions is just look at the XHB, the home builders, and just for the sake of doing this again, we'll go with the comparison line. And we'll throw on the SPX is fine in pink. And, it's really not been divergent for a very long time in the past, right? This is here, this pullback's here, this sort of struggle is this before the election gap up, and now everything's starting to fade. So is this putting bearish pressure into the market? Probably. right? Probably. We can remove that, and there's another sector I want to show you. We've talked about it in the past here on the channel, but more so associated with the IWM. But let's go XBI. Biotechs, right? What do biotechs tell us about the market? Biotechs are the epitome of risk-taking in the market. R&D costs are through the roof. Unless you truly think that you're going to be able to generate a return on the R&D, then you don't participate in risks like this. So what are one of the factors for that taking place? Of course, interest rates. So XBI as a signal for risk on and risk off, threatening these lows, definitely looks to be slightly more risk off than it does risk on in the short term, right? Let's take a look at some sector ratio charts now. We'll actually ratio these to the S&P 500. And what I want to do in this, again, in the spirit of exploring how deep these things can potentially get for the S&P 500, is actually look at some yearly day time frame charts. All right, so that's actually, let's get crazy here. Let's go to a 3-year weekly time frame chart, and we just want to clearly be able to see what risk on versus risk off looks like. Obviously, as the S&P is rallying, this is risk on. Are we stagnating a little bit? Yes. Is it risk off? Oh my goodness, it's crashing. It's in a big bearish downtrend. Are we underneath this swing low from back here? No, but I'm just trying to paint the picture that this really isn't, the improvements were made over here, but they couldn't really stay. We didn't see that firm retracement up towards these highs, right? So a little bit of a laggard here in the XLK. Let's jump on over. The XLF. Does this look as risk on as this clean uptrend here? I mean, there's the potential for a higher low, right? But what else is there the potential for? A lower high. We're underneath the weekly 50 SMA. Does not look as convincing anymore, right? Let's take a look here. This is the XLV healthcare relative to the S&P. This is D for defensive. So this is kind of what risk on looks like. Risk off looks like this. Risk off can even look like this. If we grab, we're back to it. I'm just realizing now that this did not sustain the time frames across all of these charts. So my apologies. We'll have to go back to financials as well. I'm going to have to make note of that so I don't misinform you. It's still the same concept. Obviously, as this is risk on, this is starting to look like a little bit of a threat, right? I would say that larger concerns would emerge underneath, quote, 81. 81 is not an important price level, but as a level of the ratio, that's sort of what we would be looking for. Underneath that becomes more concerning, but it's certainly not producing the best high or low. I'd maintain a little bit more of a bullish stance if we're above this, looking for it. But if it cracks, that's where things start to get a little bit more ugly. Okay, back on track with the proper time frames. We know that the market really rallied through 2023, 2024. This is what risk on looks like. If it starts to curl up, not really a big concern. So this actually sides a little bit more so with a bullish S&P. Let's continue along. This is the discretionary sector, going back out to a yearly or a weekly yearly time frame view here. This is risk on. There was actually a really big disjoint in the discretionary sector as Amazon and Tesla went sideways, where this was actually lower through a majority of these. So this disconnect we had been tracking through the XLY relative to the XLP, and that was more so stuck in a range going sideways, right? So we'll check in on that one too in just a moment. But this does not really look like a big issue, a risk-off issue. I would say that it needs to set now some sort of higher low relative to the 50 SMA if over time that weekly pullback, just to sort of bring this full circle. I know we're talking about a lot of data points. We're traversing different time frames. To bring this full circle, if this sets a higher low here, I would be more constructive on the S&P 500 setting a weekly higher low here, right? That's how those two things connect, just to sort of put the two pieces of the puzzle together. Why did I click that? I want to click this. Let's move along to industrials. Let's actually just focus on the risk off sectors here. So that way we can sort of save a little bit of time there. This is XLP, D for defensive, XLP consumer staples, right? Is there a huge flight to safety going on? No. I mean, this is sitting on the lowest low in the ratio here. So this actually supports, once again, a little bit more of that bullish stance in the S&P. And then we want to do utilities as well on a weekly time frame chart. Utilities starting to give a little bit of a tone change with these higher lows, but is this a big breakout? Is this like signaling, oh my goodness, everybody's concerned? Not yet, absolutely. And the other thing we would do is just take a look at energy. Where's energy? There it is, XLE. This is energy relative to the S&P 500. Let's go back even further because I do want to acknowledge the inflation argument here. This is what concerns about inflation look like. This is when energy severely outperforms the S&P 500, right? And you could think about everything from fuel oil to heat your home all the way to gasoline. Things get out of control. And we know about that from the sickness era, of course. So this is concerns about inflation. This is like not as concerned. A little bit of an uptick here, maybe trying to suggest a lower high could be produced. But if this was to change tone over the 50 SMA, then I would say, okay, buckle up. It's going to become a rocky road ahead. And we're probably not just going to have a clean, gentle pullback to, we want to go back to the S&P. We're not going to have this clean, gentle pullback like this. Inflation concerns really heat up and rates get out of control. you get a shaky S&P if you start breaking down underneath this level. That would really mark like huge concerns for the marketplace, right? At least relative to the easy ride we've had over the last couple of years. Okay, we've covered the sectors from a higher time frame view, which we don't often do, but I did want to bring that up considering the introduction there today. As we take a look at some specialized ratios, neutral but starting to break down, a subtle shift in tone. Neutral starting to break down, a subtle shift in tone. Still has the opportunity here more so than here to produce a higher low over the 50. This is still looking risk on. This is still looking risk on over here as well, although I will say the best higher low would have been over the top end of the range here. Japanese yen carry trade, not an issue, not blowing up at all. So we're all set on that one. Let's move along to, here we go, the dollar and see what's going on. Speaking with currencies, moving in the upward direction. Obviously, the dollar strengthening here on the prospect of tariffs, of course, as well as just the inflation issue and the Fed keeping rates higher for longer. Won't be a shocker then to see that interest rates are breaking out big time on the Friday session. You can see that there is that path to 5%. Here's 5% on the TNX up above. We have daily and weekly charts respectively. You know, inflation, it's the CPI print on Wednesday. If it comes in hot, expect 5%. If it comes in better than the expectations, I think that the market might consolidate up here. You have another opportunity. It might not be the 4.71. It might be more like 4.65. So let's actually adjust this. I will just point out before I move that level, we did breach that previous high on the Friday session, which is important. So we have a higher high. But what I do want to do is adjust this. Let's remove that and bring this down to this, right? Because any subsequent higher lows that are set, it's really over 46.5 we want, which is 4.65 on the 10-year. Any higher lows over that, just continue the trend, right? Lows, possible higher lows. Brigade bolting over the prior resistance. So 4.65 key level on the 10-year to watch as we go forward. Let's check in on gold. I realized we skipped that when we were talking about the dollar. One thing I do want to point out here is the breakout in the relative strength line, gold ratioed to the S&P 500, certainly suggesting that there's a subtle, more so relative to this prior range back here. There's a bit more of a flight to safety happening in gold, concerns about inflation as that breaks out. So it's something to keep tabs on. And again, the weight of the evidence, I remember for a very long time into the end of 2024, we would just breeze through all of these charts and say, this is not a concern, this is fine, this is risk on. We can see the shifting in the data points as we're moving forward here in this analysis. So I know it might feel like we're belaboring the point, but really taking the time to understand these changes, I think, is what keeps you on the right side of the market. Anyways, here's the inverted ZT, threatening a breakout over this, as we've said, and I don't think it's as crazy as people think anymore. You're starting to see headlines about this. The Fed's rate cutting cycle could be over, right? That's first and foremost. But if this continues to move in the upward direction, if inflation's out of control, the Fed might be forced back into raising rates, as uncomfortable as that might sound. So speaking of the Fed, speaking of rates, let's take a look at the tracker tool here. And as this loads up, looks like a little data refresh happened in the background, so apologies for that not being preloaded. Looks like the first cut is still being priced in the June timeframe here, about 44.5% odds. Very similar to where we landed on the Friday session after the labor report. I wouldn't be surprised if CPI is the next influence here. And what you're going to want to watch for, you might still see an unchanged date. You might still see the market pricing in the June timeframe. But what you want to pay attention to is just the shift of the percentage point here versus the percentage point here. What we actually ended up seeing on Friday was this bumped up to like 40%. It was 40-40 here, and then much smaller odds here, and basically 0 here and 0 here. So that will tell you everything you need to know about the market's expectation of future rate cuts, whether or not it's going to be in June, and whether or not it becomes more likely that it's a 50-50 coin toss between a pause or a cut there, right? That would, of course, push it out one more month to July. Let's go back on over to, now that we've covered that, the calendar here, and we want to go back to last week and just give you the quick rundown. If you missed the Wednesday video, we'll give you the rundown of the data points. On Tuesday, ISM Services PMI, specifically the prices paid component, came in at a 64. I want to say. We could do this in real time. Let's go tradingeconomics.com. Perfect. And you guys can go to these things as well. Feel free to use all of these resources. Let's go to previous week. Good. And we want prices paid on ISM Services right here. There it is. So 64 on services PMI. That's inflationary. So again, what should we be thinking about for Wednesday? Probably inflationary. JOLTS job openings, incredibly strong, beating by about 400,000. Huge move there is giving the labor market strength, and obviously means that the Fed does not need to respond as quickly to to cut rates, basically. So you can see that here as well. There's your big beat. We'll stay on this one. It's a little bit more familiar. ADP non-farm gave us a preview of still job growth. We have a positive print here, but it missed the expectation. Unemployment claims incredibly strong. Right, you could see here falling off of a cliff. So was anybody really surprised when on Friday the non-farm payrolls came in stronger and the unemployment rate saw a downtick? Not really. Right? Not really whatsoever. So remember that we're in this sick and twisted mindset for the market right now, where good news, specifically in the labor market, not the inflation side of the equation here, but good news in the labor market is going to be bad news for the market, right? So unemployment rate at 4.1. Remember that the Fed had projected for the calendar year of 2025 in the updated SEP that the unemployment rate could bump as high as 4.3, and they would be A-okay with that. So obviously a 4.1 gives them leeway to say, yeah, we're just going to keep rates where they're at. Heck, we could even raise rates, and if the unemployment rate goes back to a 4.2, back to a 4.3, then we'll start to consider, maybe we'll cut back again, and we'll just sort of have this dance with interest rates. But that's the idea here from the SEP, is that the Fed, based on what's going on with the labor market, is not in a rush to cut rates, especially when we can see that in this upcoming week, and we'll look at the core, not even just core, but CPI here, forecasts are for a 2.9. Let's look at the year over year non-core. 2.9 versus prior at 2.7. That is not progress towards the Fed's target of 2% inflation, right? And we saw why. It might be energy, it might be copper. There's a number of things that are possibly pressuring this back to the upside. Goods inflation is really coming back. Shelter inflation has somewhat moderated, but goods inflation coming back is just going to unwind any of the pressure that was taken out from services as it moved lower through calendar year 23, right? And even 24, there was a substantial move lower with that 12-month lag from shelter in particular. But anyways, long story short, inflation and the labor market are telling us right now, based on these projections and the actual data in hand from Friday, the Fed's not in a rush to cut rates by any stretch of the imagination, right? We could see that as reflected in the tracker tool here. Here's the earnings calendar. As this, again, must have done a load in the background. The big thing that we want to pay attention to is on the 15th, Wednesday, JP Morgan reports earnings. They're kicking off big banks. That's really when we know earnings season is upon us. I will say another honorable mention here, of course, will be TSM, the semiconductor space happening here. United Healthcare also will be interesting to see what comes of that. And then we'll start to get into tech a couple weeks from here. Usually Netflix is the first one from the tech side of things to report. I believe that is the following week on the 21st. Let's get back on over to the platform. Let's finish up this video. If it's not already too long, I'm sure you're saying, wrap it up already. Let's go over here. When there's a lot of change happening in the market, you're going to get a longer video as we thoroughly examine the data points, right? So here we have it. The TLT ratio to the S&P is certainly trying to bottom. It has not, reversed cleanly yet. If it does, that would just be a risk-off style indication here, or a flight to safety, as we say. Let's take a look at bonds relative to themselves, and as you can see, they continue to move in the upward direction, undoubtedly, as fears about inflation continue to persist. We can bring this out to a much higher time frame chart, and we can illustrate this once again. Let's go out to like a 10-year chart just to show this. So as the market was really struggling in 2022, right, that's this sort of steep thing happening here. As we were moderating through the past couple of years, that's really where we have, concerns about inflation less of an issue, right? So this big uptrend happening here, and then finally some stagnation. I wouldn't call it the cleanest. There's still higher lows, absolutely. But as this continues to push higher, that's like, fears of inflation round 2 certainly start to emerge again. Really a stable and flat read like this is where the market's not really concerned at all about inflation, right? This is the sickness that threw everything off, and this is the aftermath. This is, hey, let's print unlimited money. Anyways, let's move along to credit spreads. Speaking of volatility, which we talked about earlier in the show, right, with the correlation degree, you can see here that credit spreads continue to expand. What does that indicate? Higher volatility, which is exactly what we're seeing in the market. So expect that to continue to be an issue. As we look at the HYG in isolation, yes, it broke down here, but I think the more important one that we've been tracking is the LQD, if we could get the Q there, noting the break of the equal lows, right? We had said, I think it was either Wednesday or last Saturday, that you want to watch this equal low. If that breaks down, it doesn't really matter what the S&P thinks it's doing over here. That's probably going to be a headwind, and that ultimately, ended up being correct. As we take a look at, let's continue along to Bitcoin. This is an interesting one because I do believe that it has the opportunity to break down through this thin structure breakout. But again, this to me is one of those things where this is a risk on, risk off asset. I don't care what you say. I don't care if you're like, it's a store of value, it's to this, it's to that. it's a risk on, risk off asset. Until proven otherwise, until there's a mass use case, until you can do something with Bitcoin other than sell it to the next guy at a higher price, yes, I get the bull case. It's unconfiscatable. I get that there are some things going for it. But in my view, it is a risk asset as of right now. And for that reason, I believe if this pulls back, it will correlate with the S&P, with the NASDAQ moving to the downside as well. And if we find Bitcoin catching support here around 71.5 for a higher low, that to me would support the argument that it's possible over in the S&P 500, Bitcoin breaks down, right, gets to its retest level. The market breaks down, gets to its retest level. The NASDAQ never really budges underneath its previous all-time high. This sets up the next long. So that's an opportunity to just understand there. That's not quite data point number, what are we on now? That would have been number 4. Number 3 was the sectors. This is not quite data point number 4. We could call it like 3.5, right? Maybe you could consider this 3.5 over in BTC. So watching 71.5 and 94.650, if it breaks those lows, look at the Sailor shift ratio. It has been signaling a sell side move. Under these lows, it should start to pull back. So watching that closely out of Bitcoin as a risk on, risk off sentiment gauge. This is truly number 4, or at least what I had planned in my head to be number 4. And what I want to compare here is 2 times in history where we've seen something somewhat similar. So let's do this and let's do this so we can align this. If you're following us over on X, you might have already seen the tweet here about this, or the post, I should say. They're no longer tweets. If I do something along these lines, take a look at this segment of price action right here on both. Oh, I should have just went straight through. My apologies. Let's do this and let's do this. Thank you for bearing with me. This is where for the first time in a little while, at least at that point, and there was a previous example back there, but after the breakout of the inverted head and shoulders on the S&P weekly, right? We had talked about on the weekly chart that pullback into the end of 2023, this move here before starting to rally for the next leg. And that is exactly where the breadth did something very interesting to me. So this is point number 4. New highs versus lows goes negative. And the daily 200 SMA, so that's the green moving average here, or the number of companies in the S&P who are trading above the 200 SMA, that's the green line on the screen currently, goes underneath the 50% mark, right? Your companies in the S&P underneath the 50 SMA, or I should say over the 50 SMA, the percentage of companies over the 50 SMA is the blue line, was already slightly negative at that point here. Breadth goes negative, new highs versus lows under the 0 line here. Now, again, what I'm getting at is just compare this to what's starting to unfold right before our very eyes. And maybe white is not the best color. Let's try red again. So here we go. You're already well underneath on the blue line. The green line is testing the 50% mark, and new highs versus lows have flipped red. So does this support the idea that you could get that deeper pullback to here and retest the weekly breakout level? I think so. So through the data points that we've examined through the session today, I think for the most part, a base case here that's very reasonable out of the S&P is a retest of that 565. That's sort of what I'm gathering as we move through this. It doesn't mean it has to happen tomorrow. It doesn't mean that there can't be a counter trend move, right? That's the misunderstanding that everybody, Matt's finally got bearish at the very bottom of the move. Look, it rallied, ha ha ha. Whatever, fine. But if it sets a lower high, I think the base case is still there to move into this retest level, right? That's what I'm seeing here. Now, with respect, of course, to that QQQ 503. Anyhow, RSP, not a shocker, breaking down under the equal lows of the flag here. That is bearish pressure for the weighted S&P down below. You'll see something similar in terms of the divergence with the equal weight NASDAQ already trading towards the lows of this, which is the equivalent of this level here. There's quite a distance to make up. As we take a look at the Dow Jones, industrials versus transports, this is consolidating here, which to me, this would be an example of like where you don't want to get short dead on the lows of the move. If this just even pops over the 16,150, I think there's a counter trend that could easily take back some of this thin structure. The question just becomes, does it set a lower high here and become a headwind once again? So watching that. Let's move into volatility, which I've got a new chart to share with you, or a new iteration of a chart to share with you today. VIX is still over 15. Again, it's not over the 20 handle yet, but again, we've seen many indications of volatility from correlation to the credit spreads widening just a moment ago as well. So don't expect volatility to wane too much. You could see something similar here in the VVIX continuing to persist with these higher lows. All it's going to take is a move over 120 and you're rocking and rolling. And here's the new iteration of a chart I do want to share with you. What I've done basically, it's still the same. We're looking at volatility futures up here, backwardation and contango, but you'll notice there are other lines on there. So let me just go ahead and move full screen here for a moment on this particular chart. They might be a little bit smaller on your screen, and they are gray. They might be harder to see, but I like it this way so we can just sort of make sense of what's what. The white line is the front month versus the back month. The next dim gray line is that back month versus its next back month, the next gray. You see where I'm going with this, right? You're just continuing to compare different volatility contracts to themselves. And what we'll notice here is that, yes, we are still in a contango, in the most up-to-date contract in volatility futures. And even the next backward, or the next series beyond that is still in a contango. But look at these longer run contracts, right? Maybe if I hover my cursor on them, you can sort of see that they're closer to the zero line. They're threatening a backwardation here. Right, so if those move into a backwardation, and again, for anybody who doesn't really follow this stuff exactly, all I'm doing is comparing. Oops, we want to get rid of this. All I'm doing is comparing this current contract versus the next back month. Then I'm comparing this to this. Then I'm comparing this to this. Right, so we're just going out in time, and you can see this here that there's nothing. There's zero. When you go out to J versus K, there's no contango there. They're equal, 1950. So what does that mean? Why is this important? Because this is basically telling us that if these start to drift negative, which would be backwardation, volatility is just going to absolutely, go through the roof. And what is typically associated with volatility? Uncertainty in the market, larger downdrafts in the market. So I think this kind of supports the idea that, once again, in the S&P 500, you're probably looking for something that is more appropriately testing that 565. So that is that new chart of the day. Let's move along into our core list of companies. I'll send you on your way with those 5 trade ideas, and you can go enjoy your weekend. Here's NVIDIA on the daily time frame chart. Biggest failure here is just the lack of hold off of that 140 level. You'll notice that it actually produced a upper wick, lower high rejection of the 50 SMA, the big inflection point there. You can see it clear as day on the hourly time frame chart here. If this was the inverted head and shoulders, the neckline did not offer any semblance of high or low support there. So walking forward, do I want to be a new money short inside of this choppy, sloppy range? Not really. The best place to be short, of course, would have been the all-time high. That's being a hindsight hero, in my opinion, so I don't personally think that would have made much sense. So now the idea seeking new shorts in NVIDIA, if it is going to continue to break down, needs to be back underneath the big time head and shoulders neckline, right? This is the one that everybody was paying attention to here, myself included. And if it gets back underneath 132.25, I think it's game on again. And maybe we see a little bit of drawdown ahead of earnings. Earnings can change things here, right? So that is NVIDIA, one step at a time. I don't really think we have clean opportunities inside of this range between 140 and 135. Next up, Microsoft. Another one where I don't really think we have clean opportunities here. The daily trend is undoubtedly down, where you have these lower highs that are persisting. You had a failure to hold up over the breakout point from here, right? You clearly are getting price acceptance underneath that now. So the chart is bearish, but how do we execute in this range? Looks a little tough, looks a little tricky to me just inside of this failed breakout up here, of course. Oops, this being the failed breakout. Let's go to the hourly. I think seeking lower highs is the name of the game on the hourly. So anything that remains consolidating here, Brigade bolts underneath the 2 equal lows, 416.25. The issue with being a swing trader in Microsoft at this point is just that your reward into this low is not very high. So you almost need to be an intraday operator looking for these scalps if you're going to trade this inside of its range, right? A big new money short dead into support, looking for a swing for this to break down. I'm not seeing it. So that's that. Where would I change my tone? Sorry, let's go back to Microsoft. Where would I change my tone? Show me a recapture, show me some sort of double bottom here, get over the moving averages, get over 426.65, then we'll start talking more firmly on the long side. Apple's interesting to me because this is basically what I'm expecting of the S&P 500, right? We had this big breakout, we get this retest. This is that weekly retest level, 1, 2, 3, sort of 4-ish happening in there. This is a little shy. But anyways, this big high or low opportunity to me is very attractive. I mean, look at the Apple hammer candle from Friday. 50 SMA is still there. We closed underneath. If we could spot some way to participate long here, I think it makes sense to try to navigate risk reward like this to the upside. This is a big weekly, monthly retest level for Apple that I think a lot of people have eyes on. So 236.50, as long as it holds, I think we're in business there. Ways that this could potentially unfold. Higher lows here, hourly double bottom. You could take the Brigade bolt over the neckline, that 236.50. You could try to participate on the higher low if it wants to respect this at 234.50, a higher low over the previous day's low. You could even wait and say, hey, this to me is a little bit too risky. I think that there's an opportunity for a rejection here. You could wait for some sort of higher low back up here. Then what do we build, right? You have one of these that starts to unfold, and then you could play it as an inverted head and shoulders back up to the all-time high over time. That's much more of a longer time frame idea. Don't expect that, in the next 5 trading sessions, we're up at the all-time high. So that's Apple. Downside, there's thin structure into 230, right? If you look left far enough, this thin structure on the way higher can be retraced easily. So 230 is at least attractive, but it would have to be a no-brainer to get involved on the lowest low of the trend count, right? And at the big weekly level. Here's Amazon. Let's go to a daily time frame chart. Very hard to be bearish on Amazon, in my opinion here. You do have this, range which is starting to break down, but I'm still a fan of looking for higher lows on Amazon around 214. If this hammer is going to be it, then maybe that's all we get. But if we do move a little bit lower, the daily 50 SMA, the gap fill reversal at 214, I would look for this. And if you want better confirmation, it would just be the higher low back over 220 there. So still thinking about Amazon longs on sustained pullbacks. I would start to change my tone if it finds acceptance down here. That's where I would say, enough's enough. Probably not looking for the higher low. Flip to neutral and entertain more short ideas intraday. So that's that. Amazon's an easy one. Google is a difficult one with not much daily clarity here. I mean, of course, the big pattern that a lot of folks were watching, and rightfully so, was the compressing wedge. It broke out for a couple days, and now it's just in the midpoint, the apex of that wedge. So I don't really see this chart with that much clarity. I still think that it's just basically ranging in this box. You're in the midpoint. Don't exchange in the range. Don't enter in the center. Don't diddle in the middle. Not really a big fan of Google here. So we'll wait for some more information to develop out of that one before building better theses. What do we see out of Meta? Balance range here offering lows, the highs of it, offering lows on that Friday session. TikTok ban certainly helping, and Dana White being hired to the board. So we'll see if it can persist over this 607.75. I think that on the hourly time frame chart, we can start to get a little bit more clarity here. Some sort of long off of this 614.75 gets interesting to target this. Like one step at a time in this, it's obviously been a very volatile range with all these catalysts. But generally speaking, sustained holds over 607.75. Let's seek the top end of the range. If we fail that, yes, there it is. There's your double top. Neckline underneath should technically target the bottom end of the previous range at 588.25. So 607.75 top watch here out of Meta early in the week. Tesla, everybody's favorite. Let's take a look at the daily time frame chart first. Hammer candle, no lower low. I don't know about you, but that is definitely divergent to what we've been seeing in the broad market itself. If this is it, if this is the depth of the pullback that we're going to get, very, very interesting. No test of the full level at 358.50. No test of the daily 50 SMA. Hammer candle on Friday. All it's got to do here is show me some love over 415. I think you're back off to the races towards the highs. That'll help the case for the S&P and the NASDAQ to remain slightly more bullish. That is on Tesla here. So watching the hammer, how do we participate? Let's take a look at the Friday session on the hourly. Inverted head and shoulders on the hourly. Possible neckline in here. It's a little tricky to, you'd have to look for a scalp that does this, first of all, respectful of 415. But beyond that, you're talking about this on the daily chart as we just described. So Brigade bolt over that 415. If it's going to be bearish, just take a look at the first hourly bar of the Friday session. You want to get involved at these lows as a new money short? I don't think that's been a good idea, especially coming into that weekly retest level, that daily retest level at 358.50. I think the retest higher low long is the opportunity here out of Tesla, no matter how it plays. And we'll sort of say, okay, we're going to set that on the back burner if we don't get any sustained hold down here at 358.50. So Tesla, that is what we got there. JP Morgan earnings, again, on Wednesday. Please be mindful of that inside the midpoint of its range. There's nothing to really do here. This really just keeps me abreast of what's happening in the XLF, I would say. We'll see. If it's in the range, maybe this over time. We'll take that one step at a time. Netflix earnings, a little bit further out, but the first one of the big tech cohort. And as we've been pointing out, remember, earnings, run. Earnings, run. Earnings, run. Earnings, and consolidation here, run. So it doesn't have to play out the same exact way. At some point, the pattern will break. But if this pullback is going to yield some consolidation ahead of earnings, and then we get some sort of move back to the upside, I think that becomes a little bit more constructive, right? You saw this breakdown underneath prior lows. It became difficult to get involved unless you finally spotted the momentum. I think we could be dealing with a very similar situation where we've pulled back. If we do get consolidation, there might be some sort of recapture of some of these key levels. So 868, 907.25, those would be the key levels I continue to watch here out of Netflix if it's going to go for its, mind of its own style run post earnings like it's done a couple of times in the past here. So that is that. I would keep it simple on Netflix. It's a tough one to trade. It's a little bit more spready, so would not be seeking shorts through any of this to the downside there. Anyways, a couple of trade ideas for you. First of all, let's start with some new ones. GEV, GE Vernova. What do we see over here? Fueling the AI data center future. Couple of hammers back to back. I will just give you a little bit of transparency. I added this to the long term as they were going through their spin-off phases. I think I have GEV from, I want to say like low 200s, maybe somewhere in here. Anyways, I am long the name in a longer term portfolio, but I think that even as a trade idea up here over the range, it is a very clean setup. Back-to-back hammers, clearly exhibiting relative strength to the broad market. All it's going to take is a counter trend move in the S&P, and this flies over 373.50. I should be careful with my words. We typically don't like emotionally charged words, so there's the potential for a breakout over 373.50 if the broad market goes for a counter trend. How's that? Not interested if it falls back down into range, okay? That's GEV. Next up, BA, Boeing. Can you believe it? This pile of trash, for what it's worth, is actually setting up something very interesting. It's recaptured the 50 SMA. It's recaptured the 200 SMA. It's pulled back kindly, gently, through this rally. It swept the lows on the Friday session and closed back in range. Flat highs here to clearly break out. There's a day trade to be had for something along these lines. 173.50, 180.150 becomes the target. Here it is on the hourly, right? Look at all these equal lows. Look at the flush point. Look at how the daily 200 SMA is right there. Sellers sweep it. Cannot stick a lower high underneath. Overhead supply does not confirm. We close in range. This is the trade idea for the week. All right, so BA possibly over 173.50 into 180.150. Next up, PYPL. Oops, I'm not typing in the PYPL. PayPal, bearish trade idea, right? And this more so aligns with probably Bitcoin, right? PayPal underneath this 84.75, underneath the daily 50 SMA. Broad market continues to pull back. Looking for weakness. This is a straight up move back here. Probably gets retraced more easily into 77. So 84.75 lower highs. Looking for that style idea into the upcoming week. You can see it on the hourly. It's basically the same thing. A very, very clean neckline here out of PayPal. And then the final two trade ideas to make the full five is just some rehashing of the Wednesday session. So VST comes back into our view as it also displayed incredible relative strength. Very similar, of course, to that GEV. So VST in here, consolidation Brigade bolts over 169. That is still on the radar for potential longs. And then the next one to check back in on is TSM. Keep in mind they have earnings this, Thursday before the open. So you're going to have to button things up Wednesday before the close, of course. But big retest of the major level from back here. Hammer candle on Friday, swept the low and then closed back above. I would tend to think that if there is going to be a long here, it's maybe something that looks like this. Intraday, intra-week for some upside there. Let's take a look at the hourly time frame chart. There's your big low sweep in the morning session. Consolidation over 208. Brigade bolts here, looking for entries. If there's like one of these, even minor, like an even more minor Brigade bolt like that, looking for entries. TSM, still very interested here on the retest of this prior high. So that is going to do it for this weekend's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. If you're new here and you enjoyed the analysis, don't forget to subscribe. We, of course, put these videos out twice a week, Saturday and Wednesday, and we're live every single morning for the pre-market prep, 8 o'clock Eastern time here on the channel. You can come hang out, build a game plan with us for the session ahead. We hope to see you there. So have yourself a green trading week. Hopefully your new year is off to a strong start, and I will see you in the next one.